How does volatility affect strike price selection? Have you ever wondered how volatility impacts your choices in options trading, especially when selecting strike prices? Let's break it down in a straightforward way. Volatility refers to how much the price of a stock is expected to fluctuate over time. When volatility is high, traders expect bigger price swings. This can significantly influence which strike prices you might consider. When implied volatility is elevated, it opens up a wider range of strike prices. Traders may look at options that are further away from the current stock price. For example, if you are considering call options, you might think about strike prices that are higher than the current price. If you are looking at put options, you might consider lower strike prices. The reasoning here is that with greater price movement expected, there is a better chance that these options could become profitable. On the flip side, in a low volatility environment, traders usually prefer strike prices that are closer to the current market price. This is because the likelihood of significant price movements is lower. Choosing a strike price that is too far away may not make sense when the stock is not expected to move much. Another important aspect is how volatility affects option premiums. Higher volatility generally leads to higher premiums for options, especially for those that are out of the money. This is because the chances of these options finishing into money increase with volatility. As a trader, you will need to weigh the higher costs against the potential for larger gains. In contrast, lower volatility results in cheaper options, but also reduces the chances of big price moves that would make distant strike prices worthwhile. Risk and reward play a big role in strike price selection as well. With high volatility, selecting strike prices further from the current price can lead to larger profit potential, but it also comes with increased risk and higher premiums. You need to consider your own risk tolerance. Are you looking for quick gains with options that are near the money, or are you willing to pay more for the chance of larger moves with out-of-the-money options? In low volatility situations, more conservative strike prices near the current price can help reduce risk, but they also limit your upside potential. Time to expiration is another factor that interacts with volatility. When you have high volatility combined with a longer time until expiration, you can afford to select strike prices that are further away from the current price. This is because there is more time for the stock to make the necessary moves. However, for shorter-term options, it is often better to choose strike prices that are closer to the current price to increase the chances of profitability within that limited time frame. For swing traders using options, volatility is a guiding factor in their strike price choices based on expected price movements over days or weeks. In times of elevated volatility, swing traders might opt for strikes that are further out of the money to take advantage of anticipated large moves. When volatility is low, they may prefer strikes that are closer to the current price to capture smaller, more likely price changes. In summary, volatility plays a significant role in how you select strike prices in options trading. Higher volatility encourages traders to consider strike prices that are further from the current market price, while lower volatility favors options that are closer. Understanding this relationship can help you make more informed decisions and identify swing trading opportunities effectively.